It's a structural shift. It is a major, major structural shift away from what was prior to 1971. That's when the current contracts, the spot market contracts for gold and silver were created. And they were designed as a tool of perception management, which is actually a real formalized program for the government.
Wow.
Because if they can manage how you perceive things, then they can dictate the direction that you go in, which is their direction. But considering what was happening in the early 70s, we were shifting completely off the gold standard. And really, what did we do? We confiscated gold. I never thought about it like this, but I was working on some confiscation stuff. And I went, wait a minute. Foreign governments sent over their gold for safekeeping here in the U.S. with the Bretton Woods promise that they could convert their dollars that they were holding in its place of the gold for the gold whenever they wanted to. And then Nixon said, nope, you can't have it. That is a confiscation, period. Even though nobody likes to say it because, they don't want anybody to think that there could possibly be another overt confiscation, particularly in the U.S., let alone anywhere else. Canada is real ripe for that, even though they've never had a formal confiscation. So, the spot contracts are about pushing people away from the metals forever until this shift a year ago in January happened, where a contract for delivery was actually, for both gold and silver, happened quite a bit. Contracts, they wanted to take delivery of the physical metal. But in the U.S., we're primarily contract driven. It's everywhere else in the world. You brought up the Shanghai Exchange, LBMA, right? The refineries in Switzerland. In Europe and everywhere else in the world, they're more physically driven. But now all of a sudden, so much of that physical inventory was shipped here to the U.S. A little bit has gone back there, but really the lion's share of it was not only shipped to the U.S., but delivered out to whoever demanded delivery, which I don't think we're done seeing those fireworks yet. But that was really a major, major shift. So, of course, paper contracts, you can create as much gold and silver as you want to. It's cheap, it's easy, it's no big deal. And it's just typically about, buying the contract here, selling it there, and making your spread. But at the Shanghai Exchange, where it's physical, or even here where we had backwardation, where the current price to take delivery of gold and silver was higher than the futures market, which is typically an anomaly. I mean, that's what's showing the cracks and how this is growing larger and larger and larger. So I'm excited about it. It's about time.
Under the Bretton Woods system, foreign governments held U.S. dollars with the assurance they could exchange them for gold. When convertibility ended, that promise effectively disappeared. While rarely labeled as such, many critics argue this represented a form of financial confiscation, gold pledged but no longer redeemable. The shift fundamentally changed trust in sovereign guarantees. Decades later, the consequences still ripple through global reserves and monetary diplomacy. Confidence in paper claims replaced direct ownership. Yet history shows that trust in monetary systems can erode slowly and then suddenly when promises outpace tangible backing.
I think that's true. And what I was saying when they were even talking about the audit is, okay, they could have, so my guess is they don't have a room full of gold bars, right? But they could even have that room full of gold bars. What I wanted to see was the ownership string. Because if you look on the chart of, and really understanding that, again, going back even to the spot market, the goal was to keep people away from sound money. So sound money, physical gold, physical silver, these are metals that are above central banks, and people don't necessarily understand what that is, but I can sit here and I can tell you there are 33 individual users of physical gold in the global economy. There
Right.
are 36 physical users of physical silver in the global economy. That's
Wow.
way bigger than any one government or one central bank. They can't control it,
Right.
nor have they been able to duplicate the properties that are found in gold and silver. This is the only money that was not created by man, right?
Right.
So it's sound money, and they don't want you to have it because then they can't evaporate or inflate your wealth away like this $10 trillion Zimbabwe note. So I'm a trillionaire, but I can't buy anything with it. We just get blinded by numbers. And so all of this volatility that we're now seeing, it's like an expansion bridge. And it looks solid and it works really well, except that there's a little crack in it. And then that crack keeps growing and growing and growing.
Right.
So I think what you're seeing is that the smart money is accumulating the physical.
Today's precious metals market is divided between paper trading and physical ownership. Exchanges such as the Shanghai Gold Exchange emphasize physical settlement, while Western systems have historically leaned on derivatives. Recently, unusual market signals, like backwardation, where spot prices exceed futures, have hinted at tight physical supply. Large volumes of bullion have moved across borders, particularly into U.S. vaults, as delivery requests increased. Such events are rare and often interpreted as stress within the pricing mechanism. When more participants demand tangible metal instead of contracts, it suggests confidence may be shifting from paper promises to physical possession.
It ends in a hyperinflationary depression. I'm sorry, Ivan. I wish I could say something different, but then maybe I don't wish I could say something different.
Right.
Because what we're looking at on ever so many levels are zombie governments, zombie corporations, and zombie consumers.
Mm-hmm.
I had someone on my live yesterday tell me how great the credit system is and how, with gold, you just can't expand that much, but how fabulous this is. Well, we have a major K-shaped economy where you just have like the 1%ers or the few that are doing great. But the masses that can't even figure out how to feed their families, they need to take out loans for four easy payments.
Right.
Right? I mean, what is that? Affordability matters again?
Right.
And, yeah, it does. And do valuations matter again? Yeah, they do. And how about we get back a level playing field? We aren't going to do it in a credit system, period, because the credit system is designed to favor the few against the many, and inflation is designed to get you and I to work for less and less and less without realizing it, so that instead we can't pay attention. These were their words, not mine. If people have to work harder to maintain their standard of living, they have less time to pay attention to what we're doing. That was the government and the central banks saying this.
Yeah.
Corporations wanted to pay you less. This whole thing with government and corporations being in bed together, they always have been.
Yeah.
That's why a credit system benefits those few that have access to the credit and access to the new money when it has the highest level of purchasing power. And then after that, by the time you and I get it, it has a lot less, but it still has more purchasing power at that moment in time than it ever will again. And that's by design. Yeah. And I ask everybody, why is that okay with you? Because in the U.S., it's so clear we are working for Federal Reserve notes. The Federal Reserve is a private corporation, and the note is a debt instrument. Why are you okay working with corporate debt that they are destroying, whatever value is in there? Why is that okay? It's not okay with me.
Gold and silver have unique properties, finite supply, durability, and universal recognition that distinguish them from fiat currency. Unlike debt-based money, they are not created by lending. Modern economies, however, operate on expanding credit. New money enters circulation through borrowing, benefiting early recipients while gradually reducing purchasing power for everyone else. Inflation, though often described as manageable, systematically erodes savings over time. Critics argue this structure favors those closest to monetary creation: governments, financial institutions, and major corporations, while wage earners bear the hidden cost. The result is widening inequality within what appears to be a growing economy.
Well, you can see my head going like about exploding if you want to know the truth.
Right.
And really what it boils down to is, you remember, Ivan, I've studied currencies and currency life cycles since 1987. I do not think about sound money as a trade. I think about it as insurance. And look, my insurance for my health insurance has gotten very, very, very expensive. I ain't selling it, because you need it in case of an emergency. And what is happening with this volatility and the rise in the precious metals on the spot contracts, it's telling you that this bridge, like we were saying, this bridge is breaking down. You want to get rid of your lifeboat? Oh yeah, that makes a whole lot of sense.
Right.
So I know some of the people that you're referring to, and they're frequently the same people that used to poo-poo me when I was talking about the collectible markets.
Right.
And now, yeah, sell your silver because gold and silver is a trade. No, don't sell your gold and silver. I'm very sorry. There are people I do have a level of respect for, but they do not understand what we're going through right now, period. We are resetting from the current system that I raise my right hand to God, no crosses count, right? The system died in 2008 and they had to rush to set up a new system. And hey, these same people are big crypto people too, a lot of them, right?
Yeah, that's true.
So they're embracing the surveillance economy. I do not embrace that. I want to get sound money, which means here's a concept: redeemable gold back in the global monetary system again, because I want this level playing field for my children, for your children, for our grandchildren, for our great-grandchildren, and down the road. We have to take our power back, because look at how great the public has done with those that are in power. They've done just great. Having to borrow money in 4 easy payments to feed their children, not being able to afford a house, not being able to afford an education, not being able to afford barely anything.
Yeah.
So why would we allow them to stay in power, and not only stay in power, but give them even more control?
Yeah, it's crazy.
So, yeah.
Rising asset prices in stocks, real estate, and digital currencies can create the impression of prosperity. Yet price inflation does not always equal real wealth creation. When measured against long-term purchasing power, many currencies show persistent decline. Data from the Federal Reserve itself illustrates the dollar's erosion over decades. Supporters of precious metals argue this volatility signals stress within the current debt-driven structure. If excessive leverage accumulates, corrections can be swift. In such environments, tangible assets are often viewed not as trades, but as financial insurance against systemic instability.
Number one, I think it is critically important for people to understand, no matter what it is they're doing, what's its true value? What is its true fundamental value? Not what Wall Street wants to lie to you with, or governments want to manipulate you with. So that also goes back to the other question at, what's the true fundamental value of an ounce of gold? Well, it's simple. Money's created from debt. And so you just take all the debt in the world and you divide it by all the gold. There's a finite amount of this stuff, and that gets you to somewhere between $38,000 and $40,000 an ounce. So at $5,000 an ounce, it's a bargain. Mm-hmm. But that also puts silver at a 20-to-1 ratio at about 18 to 2,000 an ounce. Why would you sell it when you know that it's really worth at this moment? And the more money they create, the higher those numbers go. They're just numbers.
Right.
Why in the world would you sell it for 100 or 120 or 84 or wherever it happens to be in a trading market at this moment in time? That's what I'm talking about. They don't understand the fundamentals of the markets, but it's really very simple. You just need to be able to determine how much is this really worth. The Federal Reserve tells you how much this is worth. Go on their FRED and put in purchasing power of the consumer dollar and look at that left-hand axis and you see a big fat zero. And that means anything you can only convert into this, I don't care how many zeros it has on there, wherever my $10 trillion note went. I don't care how many zeros it has on there. 10 trillion times zero is zero.
Yeah.
So be aware, because you see crypto going up, you see stocks going up, and you think, oh, look at that, it's a bull market. No, that's not the real market. That is just an illusion to keep you in the system so that they can rob you more easily. Because when the market crashes or they say, no, you can't liquidate, you have no choice. There's no one to talk to.
Right.
If global money is largely debt-based, one way to estimate gold's theoretical value is by comparing total outstanding debt to known above-ground supply. Some analysts suggest this calculation implies significantly higher equilibrium prices than current market levels. Whether or not such projections materialize, the broader debate centers on trust. Trust in institutions, trust in currency, and trust in long-term stability. Monetary systems throughout history have evolved and sometimes reset under pressure. The critical question is not whether volatility will continue, but how individuals choose to position themselves if confidence in the present framework continues to weaken.